Do EU rules limit margins on Forex CFDs? What is a CFD and how do I get one? And how much exposure is too much on a CFD? Let's find out. Hello traders, I'm Simon with FXEmpire, and in this video, I'm going to be breaking down CFDs, giving you all the most important need-to-know info as possible. Contracts for difference, CFDs, are financial derivative instruments that track many assets, including Forex, equity shares, commodities, indices, and cryptocurrencies. CFDs allow Forex traders to open positions using leverage and aren't the same as simply buying or selling because the contract holder doesn't own the asset. Now, it's important to note that while CFD trading isn't allowed in the US, it's still one of the main things any trader needs to know about. Before we continue, let's quickly go through some of the more important lessons you need to be taking away. But, and just one moment, don't forget to hit subscribe and the little bell next to it if you want to keep learning how to be a better trader. The first important lesson you need to be taking away with you is all parties are contractually obliged to pay the other what money is owed. A contract for difference, otherwise known as CFDs, is a contract between two or more parties agreeing on the value of a security or instrument. This means that all parties are contractually obliged to pay what money is owed, meaning while you can make a lot of money, you can also lose it. The second is that CFDs provide leverage based on the buy and sell price rather than the underlying asset. CFDs rely on their market valuation, not the asset they represent. Number 3, CFDs support greater total exposure than Forex cash markets, meaning using a CFD, you can open a huge position, but where there's a lot of money to be made, there's a lot more to be lost. And finally, you should always limit CFD exposure on a single trade to a small percentage of total capital. Doing this ensures no single trade can wipe you out. Now, let's get to the good stuff. A contract for difference has an embedded leverage feature that differs from broker-to-broker or asset-to-asset trading. Leverage allows you to take bigger exposure through borrowing capital, increasing both trading profits and losses. Current EU regulations limit leverage on major currency pairs to 30-1 and minor currency pairs to 20-1. More, those rules provide negative balance protection, meaning a trading account can never go below zero, removing the risk of suddenly finding yourself in huge debt. Forex CFDs are bought or sold in standard, mini, or micro lots or unit sizes. Those sizes correspond with $100,000, $10,000, or $1,000 worth of the underlying Forex pair. So, for example, a broker following EU rules can allow the trader to purchase 3 Euro US dollar CFD mini lots, $30,000, while posting collateral of just $1,000. That's a 30-to-1 leverage on the major pair. It's important to understand how leverage will impact your trading returns, though. Because, well, the potential of making big bucks exists, the potential of losing it all also hangs in the air. Let's take another example. If you open a CFD on Euro US dollar using 30-to-1 leverage in a $1,000 account, it will only take a 3.33% move to either double your money or wipe out completely. So while leverage can be used to make a load of cash fast, it's also a double-edged sword and can end up disastrous. So how do we actually use leverage? Well, first, the trader needs to open a margin account instead of a cash account. Each broker has different criteria for opening a margin account, but most require a higher minimum stake than a cash account. Once the margin account is open, it'll need a minimum amount of capital to stay active. There are also some regs that make traders answer questions about trading experience and investments before they can open an account. These are to prove they know what they're getting into. Each position requires the account holder to post a specific amount of funds from this capital pool, referred to as an initial margin. This money covers losses. In the event of losses, a broker will either ensure the account has enough capital to cover them, and if not, they'll just close the position automatically. As the market moves, the margin needed to maintain the trade will change. If the value of the position decreases, the broker will take a maintenance margin to cover losses in addition to the initial margin. If the value of the position increases, the initial margin will remain unchanged, and the maintenance margin will decline. The margin calculation is done in real time, telling the broker the minimum amount of capital required for the account holder to maintain the trade. If the position moves against the trader and account capital isn't increased, the broker has the right to liquidate the position. It's vital that new Forex traders understand the written margin agreement and the broker's rights to liquidate positions before starting to trade CFDs. If you don't, you risk opening huge leveraged positions with the idea of holding through hard times, only to have the position automatically closed by your broker. And that's where risk management comes in. Before you open a position, you need to jot down a list of trading rules or a trading plan. Check out the Psychology and Trading video for more about that. Next, be sure to limit the amount of exposure per individual trade. Try to use only a small percentage of your total account capital per trade. This gives you a bit of a protective barrier as your trading skills grow. Also, don't forget to place stop losses on all trades. These ensure you get out of a bad trade before it's too late. Try to be mindful and either use a trailing stop loss or periodically manually adjust your stop loss to lock in those profits. Let's sum it all up. CFDs are financial contracts that allow market participants to trade on the Forex market without purchasing or selling currency pairs. Trading CFDs requires opening a margin account at a CFD broker. Leverage can significantly enhance Forex trading returns, but can also invite damaging losses. And a well-constructed risk management plan is so necessary to trade CFDs for consistent profits. Did you learn anything new about CFDs or think we missed something? Leave a comment below to let us know. Also, if you learned anything or want to keep either growing or simply brushing up on your Forex knowledge, leave a like and subscribe. We super appreciate it. See you in part 6, how to choose the best Forex and CFD broker. Stay strong out there, traders.